What makes all of these very different crises follow the same mechanical sort of cycle? How is that even possible?
Well, everything's got these cause-effect relationships, and the way, in a nutshell, try to make it simple. There's productivity over a period of time. Our living standards rise because we learn how to do things better, and the output per man-hour worked increases, and that moves at a fairly, it'll go up and down its pace, but by and large, it's not what causes volatility. And around that, we have two debt cycles. We have a short-term debt cycle, which we understand because that's the business cycle. You're in a recession, central banks ease monetary policy, they change the relationship between short-term interest rates, long-term interest rates, asset prices, put liquidity in, and then you have debt growth. Credit is spending power. Mm-hmm. So when you extend credit, you are extending spending power, and that's good for the economy when that credit can be paid back. And what it does, of course, is it pushes asset prices up while levels of debt continue to increase. And at that part of the cycle, people and everybody is sort of conservative about that, and it pays back. But asset prices rise.
When you say pay back, you mean the borrowers have the ability to service that debt even as asset prices rise.
That's right. And everybody wins, and that's good credit growth, and it's a wonderful thing. Then as you get later in the cycle, it's a very self-reinforcing cycle because as asset prices go up, you have more collateral, people are more confident, they believe asset prices will continue to rise, they become a little bit less careful in terms of that kind of lending, they extrapolate that into the future. And then, and of course, then there's the shadow banking system. Mm. There's always a shadow banking system.
Really? Not just 08, 09? That's always existed?
No, all the time there's always a shadow banking system. There's a shadow banking system now. In other words, there's banks, and they're regulated and controlled within their parameters. And then outside of those banks are other kind of new forms of lending and capital markets and so on, or it could be online, it could be different forms. And there's a pressure to develop that outside of the system's shadow banking because the more regulated, more controlled one doesn't make as much money and so on. And so by being at the periphery, you can use higher amounts of leverage, you can do certain things, and so that grows. So you develop this shadow banking system, which is not regulated, and also investors want to go to because they'll give you a bit higher return. Even think about how the money market funds develop because by comparison to banks and so on. And so that develops outside. And it becomes so self-reinforcing because everybody makes money at it, and also they believe it because when things go up, everybody thinks things will go up.
So less regulation, more risk, better return.
That's right.
And that's late in the cycle, and then what happens?
And of course, what that does is all that demand and liquidity causes rates to come down, liquidity to go out. So like we see in this cycle. Last cycle, we brought interest rates basically down to zero, practically down. That wasn't good enough. So central banks bought $15 trillion of assets, pushed the asset prices up, pushed liquidity into the system. And so asset prices go up and people extrapolate. And the funny thing about it is, as you get to later in the cycle, when there is more debt, and you know that you're coming closer to the end of the cycle, there is more of an extrapolating in the market prices of that moving on. So if you look at what the discounted growth rates are, late in the cycle they become high, they're difficult to meet, and then you get the changing, you get the tightening of monetary policy. Tightening of monetary policy has its effect first on asset prices, and then it becomes a self-reinforcing effect. And that's the normal business cycle, a normal sort of debt cycle, because debt is credit, and credit is buying power, and economy runs on that. Then you have this longer-term debt cycle, which is the accumulation of those other cycles, because the world wants to be long. The world wants to be leveraged long. They want everything to go up. We all do. Central banks, better times. Assets go up, businesses activity, and so on, and there's a strong desire to push credit. And so the limitations that start to encounter is when you get close to zero interest rates, like we hit zero interest rates, that changes the game. And when you have, and then you need to print money and buy assets. That happened in 1932. So 29 to 32, interest rates hit zero. The central banks need to buy assets. They buy assets. They cause that carry to 1937. Very similar situation that we've been in. And so when we carry that from 2008 and 9, then you come into about a year and a half ago, we start to tighten the monetary policy. We pull that in. We have higher rates of debt growth. That thing goes on and on all over in all countries, that same basic dynamic.